My name is Rodman Schley. As a real estate expert, I've invested millions of dollars in vacation properties all around the world, and I've been involved in the valuation of billions of dollars of properties. I want to share my 35 years of experience along with vacation home investment tips from the top minds in the short-term vacation rental industry. Now, let's do the work. Hey everybody, welcome to the Vacation Property Secrets Podcast. I'm your host, Rodman Schley, and today we're going to mix it up a little bit and talk about MTRs and LTRs with Danny Beit-Or, founder of Simply Do It, an online investment platform specializing in long-term rentals. Danny's been a real estate investor for more than 20 years, helping his clients buy and sell more than 5,000 rentals across 40 U.S. metros, all done remotely and in most cases, sight unseen. Danny earned his PhD in real estate during the crash of 2008 and hopes to use all of his diverse experiences to help people learn from his mistakes as well as his successes. Danny, welcome to the show.
Hey, thank you. Thank you very much for having me. I'm happy to be here.
I think this is going to be a real interesting conversation today. I know a little bit, we talk most of the time about short-term vacation rentals and some of the investment fundamentals, but you're going to bring a unique perspective. We're going to talk a little bit about short-term rentals, but we're also going to talk about midterm and long-term.
Perfect.
And the thing is, there's very big differences in these asset classes and the investment fundamentals that go behind it. So I'm really excited to talk about those different philosophies, what makes them different, what makes them better, what makes them worse at times. I know they all have their challenges. So we're going to get into that today.
Perfect. Love that. Love that.
Yeah. Hey, Danny, can you tell people a little bit about your background?
Yeah, sure. So I'm currently based in California, Southern California. Originally from Israel, I moved to the States 21 years ago. I actually started investing in U.S. real estate while being a young engineer in Israel, Tel Aviv, Silicon Valley kind of a thing. Started saving up money and not really being happy with what I'm seeing, kind of the rat race over there and the real estate over there. And I stumbled upon, you can say, maybe on U.S. real estate investing after doing some stocks and options and other things. And that really hit, straight to the heart. It felt like it's a good match between skills, mostly personality, risk tolerance, available funds. So that was kind of my introduction as a young engineer. Completely sight unseen, completely another country, different language gaps of hours, of culture, of laws, of expectations. And I still went in and bought my first rental property, sight unseen, in 2002, just outside of Phoenix, Arizona. That was my introduction. And that was my falling in love into it with all the challenges, but also all the benefits. So that's kind of how I got started.
What was your first deal, Danny? What was your first deal?
A single family home, brand new from the builder, 4.2, I believe it was 4.2, 1,500 square foot ish, 2-car garage in a suburb called Litchfield Park for 127, 480,000. I just don't remember the numbers exactly. That was my first taste. That was not only just my taste. I bought it in 2002, and very quickly before the crash of 2008, everybody, it's been longer. A lot of people talk about the crash, but not many actually speak about what the few years before the crash of 2008, that if you were there, those were spectacular years of real estate, not crazy appreciating, but appreciating very nicely. That house doubled over 3 years-ish, I want to say, maybe 4, maybe even more than double. So I was able to refinance it twice, pull money out, and buy more houses. So that was my starting point. Trust me, man, I say that I did not expect to refinance in 3 or 4 years twice and buy more houses. That was not the plan. That was for me, it was like I bought the lottery ticket, right? I participated in the game, and then I had a winning, but it wasn't the plan.
Yeah, building long-term wealth. I always tell people there's no better way to do it than with real estate. If you're not in the real estate market, I know it gets tougher and tougher, I even think about my children now. It's like, what is their entry point going to be like when they start to buy homes under the current market conditions? But you got to start somewhere. I was even
Oh,
thinking back. I remember moving to Denver, Colorado, from Omaha, Nebraska, and I was
yeah.
in sticker shock because I had sold a home out in Omaha, Nebraska, 4-bedroom home for 110,000. This would have been back in 1998. And then when I came out to Colorado, I bought a 4-bedroom home and it was like $180,000. And I was like just in sticker shock.
Yeah.
Now, of course, that same home right now, you want to try to buy that house right now, is probably going to be at least $750,000.
Yeah.
So, you got to think
Crazy.
about the cycles. You got to think about the long-term opportunities when you're buying real estate. And sometimes it's hard right in the moment to think about how can this possibly go any higher. But look at historically what happens, and you'll see it does.
Unbelievable. It repeats itself. It's really, if you're trying to time the market, it's so difficult. But if you're saying, hey, forget about timing the market, let's just buy quality and hold it for the long term. I know we're going to dive into MTR and short term rentals and all of that. Hang on a second about those are refinement. I'm talking about just buy good quality piece of property, hold it for many years, ideally 10 or more. You will probably even hit some sort of a downturn in the middle, maybe early on, later on. But you know what? Just buying quality and hanging it for long term, you're hedging. You're hedging against what the economy is doing, and you just let it slide, kind of slide up quietly, or not quietly, but uh, um, even a little bit, 3% a year, 4% a year on average, right? Who cares if it does that along the way? Just be patient, man. Just be relaxed, be patient, let it sit there. You're not gonna sweat over what the economy is doing right now because you are long term and you're hedging. So that's easy. People miss that. I think that people don't understand that it's everything else is a little bit like a noise in the system, and you really refine it to those two things, and you very likely will do extremely well, especially if you're leveraging.
Yeah, a lot of people, they buy and sell based on fear, and
Yes.
instead of buying
Yes.
and selling based on opportunity. And unfortunately, that's the totally the opposite way of how you should be buying your properties. I mean, when things are down, I remember in 2008, '09, when we had the big bank crisis, property values were crashing. There were so many big opportunities for the people who had
Absolutely.
cash in hand that could go and seize on those opportunities. Where there is a problem for some people, there's an opportunity for others who have been savvy, who have been smart, who put their money away, who are in a good cash position to go in and capitalize.
Yes. Yeah. Yeah. Just a quick story exactly to that point. I bought a property in September of 2005. So it means we're just hitting the 20 years mark of that property for 190. I'm rounding numbers, 190 in Orlando. That property went from in 2005 from 190 all the way to 84,500. 84,500. Remember, I have the visual, right, of the estimate, right? So more than a half, right? It's like almost 55% or something like that. And I was already an experienced, but still young in the journey of a real estate investor. I'm looking at that property. I feel like crap. I feel terrible. I feel like a failure. And then I kind of have this conversation with me. It's kind of good exercise. Say, hey, listen, what's going on, man? What was your plan? Hold it for many years. Did you buy bad property? No. What are you going to do about it right now? How are you going to fix this situation of that low valuation at the moment? There's nothing I can do about it. Okay, then shut up and just continue the ride. You bought well. You're in the U.S. You're in Florida. You're in Orlando. You're in a good community. Just hang in there. You know, maybe it won't be okay, but it probably will be okay just by me shutting up, that noise and riding it. And this property is what now? By the way, this property is worth now 360, 350, depends on the day. Who cares exactly? But just to show that it did happen. And you know what? 20 years, three tenants, three tenants in 20 years. I have a combined vacancy on all those 20 years, combined 4 months, right?
Oh
In
my
20
gosh.
years.
Out of how many properties? How
Too
many
much.
properties is that, Danny?
No, I'm talking about specifically on this one. I have other great stories like this one, right? Because everybody wants the bad stories all the time. Nobody spends, a few minutes really diving into the good stories. But this one, you know, It's not an amazing property. It's not an amazing community. It's just a nice community, middle class in Orlando. I didn't spend 10 days evaluating this property. I pretty much was in the neighborhood, went, saw it. It was with a tenant. I made an offer for asking and bought it for asking, not 20% down, right? With financing. I had my challenges with the crash of all the mortgages and everything, but it stayed occupied. It's the only reason I hit 4 months of vacancy and not 3 months of vacancy. I had one, before the current tenant. I just held on to the house vacant for a month just to clean it up, to paint it up. That's the reason I have 4 months of vacancy in 20 years, right? Nothing. Truly exactly what I just said. Quality, long term. That's it. That's all that there is to it.
Yeah, and I will say this, and I'm not going to say that you cannot lose money on real estate, because you can lose money on anything.
Absolutely.
But I've been investing since 1988. So I've been buying properties for a long, long time. And I've never in my lifetime sold a property for less than I paid for it. I have never come away from a deal, even my worst deal. I remember the worst deal that I ever had. Nightmare after nightmare after nightmare. Everything from the sewer line failing to the furnaces failing, everything just failing
Everything.
on the property. I still walked away from that deal. I held on to it I only had it for like 4 months as a buy and flip. I think I made 20 grand on the deal, which is a low amount to make on the flip, but I didn't come out negative. I still came out ahead of the game.
Yeah. Yeah.
So,
Yep.
Danny, how many
I know
properties have
exactly.
you invested in over your time?
So personally, in the multiple dozens over time held, some directly ownership, many dozens of partnerships. But I am humbled with the small, whatever the amount of properties I've owned over the years. That's very humbling, because I am working with my clients, helping them buy rental properties, and I'm heavily involved with the decision of buying. And we support our clients as long as they own the property. 10, 15 years later, if they call us up with a problem, small or big, we're still involved. So I have exposure to not only my own portfolio, but we help clients buy more than 5,000 properties over the years. So I have a lot of experience before the crash, during the crash, after the crash, before COVID, during COVID, just between stuff, getting into the nitty gritty of my own or my clients, the plumbing, the HVAC, the roof, the vendor, the eviction, the lawsuit of a tenant about this situation. So many things, good and bad, over the years. So that's really my experience is way more, it's amplified just us being so heavily involved with our clients and helping them beyond the few properties that I've owned over whatever, how many number of properties I've owned over the years. So
Yeah.
that's the
Let's talk a little
experience
bit
is
about
really there. Mm.
Let's talk a little bit about investment fundamentals, because so many people don't buy property based on fundamentals. They don't understand the raw data that goes behind. They don't understand the cash flows. They don't understand how to model cash flows to see what they're going to bring back on the property. A lot
Right.
of times they'll just come in and fall in love with the property and just say, okay, let's just take a chance, like take a flyer on this thing. When
Yeah.
you're going through the process with your clients, are you showing them the financial side of the equation too, to be able to go in and go, listen, this is what the market's doing. This is what other properties on the market are doing. This is what we think your expenses are going to be. Do you guys get all the way down to NOIs on property to figure out what a cap rate might be?
Absolutely. So we have, first of all, we have the financial analysis and also the quality analysis. And because I work with a lot of engineers from Silicon Valley, they are very Excel driven, and I always have to pull them out of the Excel and say, yes, here's the Excel. Here's the approach to use the Excel, but not to abuse the Excel either way, right? Here's the data in the Excel. We can read that and understand that. And I have to remind them, this is an Excel. It's not a guaranteed. It's not for 100% accurate. We make assumptions, but it's good working tool, Excel, that I've created maybe 15 years ago or so. My guess that our ecosystem, investors, agent, and my team probably analyzed well over 150,000 properties during the Excel. I want to emphasize, analyze, not purchase. 150,000 properties. Probably myself, I only analyzed using that Excel, right, for 15 years. My guess, well over 70,000 properties. So I don't do anything without that tool. But this is a great tool for us for in a financial analysis. There's always beyond that, right? So, for example, maybe there's something happening in the neighborhood. Maybe there's something with this house that makes it a little bit financially look okay. But if you understand what you can do with it, if you add few things, or maybe something else is happening in the area, like an airport or something like this, that takes it beyond just a nice property. So I think a lot of people, in my experience, are just so sucked into the screen, looking at websites, Zillow, Redfin, Realtor.com, and such, and they're looking for answers over there, right? Even with AI, they're looking for answers, and not all the answers are there, right? It's hard to understand what kind of changes are happening in the area, what kind of an opportunity is involved beyond the numbers. No screen will tell you that. So I have to remind my clients, get out of the screen. If you don't want to travel, that's fine, but at least call the property manager, call the agent, call the local, talk to me, talk to any of us. We will give you we will close the quality gaps between the quantity data. It's really important, really, really important.
Well, I can imagine it's hard to pull those guys out of they're down there on screens all the time, especially down at Silicon Valley, where they're
Yes,
probably just so used to just getting all their data right there at their fingertips
unbelievable.
that they
Yeah,
don't get on the ground every once in a while and just kind of experience or go a little bit deeper, if you will.
yeah, for sure.
Yeah. So let's talk a little bit about the differences. I know you do a lot of long term, but you also do some midterm rentals, and a lot of the folks that come in, a lot of short term rental folks are on this podcast. They're listening to the podcast, but I'm very intrigued for them for the opportunities that happen, particularly in that midterm type rental space, because sometimes that's something we don't think about. Now, when you get into the short term space, I mean, you're constantly turning people over. You're constantly bringing people in. You're booking them in. You're getting cleaners in. There's just an entire really fast, a lot of people, a lot of turnover process going. How does that compare to your midterm type
Yeah.
rentals?
Yeah. So let me start by saying that I've had short-term rentals in the past. Not a lot of them, but I definitely played in that category over the years a few times. Would not call myself anything close to an expert. Just someone who had properties and the situation was seeming positive to have a short-term rentals. But I realize, for me, again, this is me speaking from my experience, that the short term rental for me is not the way I want to focus on. And I'm emphasizing focus on because it's a hospitality business. It's a business and it's a hospitality. And there's a lot of noise and there's a lot of friction. And either if you're doing it by yourself, it takes off your time, which is fine. I don't have a problem with it. But a lot of those late night calls, or where is the key, or the light doesn't work, and it's annoying, right? It's annoying, especially when you want to scale. And the problem is that when you use many times, not always, but when you use a property management, a professional company, which is a great solution to offset that noise, they're typically not that cheap, and they're eating into, rightfully so, eating into your profits. So if you have a house that is 90% occupied, you can accommodate the property management company. But if your house is not, maybe 50% occupied, with all your fixed costs, it's hard to carry that on as well. So there's a bit of a challenge. I will just say I was not enjoying the experience of being short-term rental person, owner. And I have to admit, maybe people don't want to say it, but over the years, the little experience that I've had with the major player platform was never pleasant, right? Let's just say far from it. I would say maybe they change. I haven't tried, but for the most part, I love the product. I don't love the support. The product is amazing. Then a few years ago, maybe 2 years ago, I've started, kind of hearing about this, you know, midterm rental. And the midterm rental for me was a good, suitable way to get into it. midterm rental, in my opinion, it's almost the big brother or the twin sister of the short-term rentals because they're very similar in many ways. The only difference is, are you set up and are you targeting in your marketing mid-term renters, or you're just focusing on the short-term renters? Now, when you're focusing on the short-term renters, many times you're going after people that will stay there for a week or two or a few days, and you choose your houses in such way. When you're going to the midterm rentals, I am actually in the suburbs. So in a way, I'm already in the category that I know very well of houses that we do for long-term rentals. I can actually every time I analyze a property for a midterm rentals, we do a triple evaluation. We want to make sure the focus is midterm rental, and then what happens as a backup if the midterm rental doesn't work and we want to convert to a long-term rental? Will this house still be, sustainable as a long-term rental? And then we definitely look at the short-term rental aspect as well. And I'll tell you why we're looking at the short-term rental aspect as well. If I'm already saying I don't want to be in that business, is because this is what we call hybrid, rental, and not midterm or short-term. Hybrid means I'm focusing on the midterm and I want those people for a month, 2, 3, and more, right? But I'm going to close the gap between the midterm rental tenant or guest to another with the short-term rental for a week, for a few days, etc. So there's the focus, and there's what you're using as to close the gaps in between one midterm rental to another. So that means I am trying to use the both worlds, short-term and midterm, with a clear focus where we want to be, and have a backup of the long-term rental just in case things did not pan out exactly like we were planning, and I want to keep this house as a long-term rental. Plus, midterm rentals are very similar to the short-term rental setup, fully furnished, right? Maybe the only difference is that it's truly fully furnished for a family to come in and live in that property with the microwave working and toaster oven and maybe pancake oven and all those little things that the family would need to stay and live and cook there for a lengthier period of time, where many times in the short-term rentals, they don't care about really cooking there. They're ordering in. They don't need all the infrastructure to really sustain their lifestyle, like they do with the short-term rentals. So that's maybe some tweaks, but that's why we focus on the short-term, on the midterm rental, and closing gap with the short-term rentals.
Hey, everybody. I hope you're enjoying this episode of the Vacation Property Seekers podcast. I want to let you know about one question that I get all the time, and that's how do I forecast my cash flow and my profitability when investing in a vacation home? Now, if you've ever wondered that or you know somebody who has, you're in the right place. We've created a free training called Financial Forecasting for Maximum Vacation Home Profitability. Now, in this training, we're going to guide you step by step on how to accurately project rental income, estimate your operating expenses, and calculate your returns so you can make informed investment decisions. You can access the free training at vacationpropertyexpertnetwork.com. So if you're ready to dive deeper into financial fundamentals and maximize your profitability, visit vacationpropertyexpertnetwork.com. Danny, everything always goes exactly the way that you plan it when you're investing in real estate. We know there's never anything that could ever side rail us or,
Never. Yeah.
It's
Yeah.
interesting to hear about it because I know that. So you're saying basically that and you've got these midterm rentals, you try to occupy that vacant space. I mean, if you got a space sitting vacant, why not try to get a short-term person in there while you're getting that midterm person back in and
Correct.
paying for several months?
Yeah.
And I'm assuming these are people like your traveling nurses and people who are on the road but might have to settle in for a few months.
No, actually, it's not. Traveling nurses. So again, what we do is we focus on the suburbs and the families, right?
Okay.
So the golden ticket would be the insurance people or people going through some insurance incident, right? And we have someone like this right now, moved, what is it, 2 weeks ago, maybe 10 days ago, to one of the houses. I'll give you an actual example. When we were evaluating this house, we were estimating the long-term rental would be just short of $2,000 a month. This is Metro Atlanta. We have a tenant guest, whatever you want to call it, for 11 months at 5,500 paid by the insurance company because their house, I think it was a fire situation. Now, the insurance is paying for it. So that's a good thing. And they want to stay in their area. They don't want to now uproot themselves into a whole, different city, or even, even nearby by 20 minutes, 30 minutes out, or closer to downtown, where all their life with the kids and school is right here. So they want to stay in their community. That's why it works in the community. And that's kind of an example of someone that I don't know if I said we're getting 5,500 for this one. 11 months, 5,500, which is more than, almost 2.5 times the long-term rental.
And that's
Um,
getting paid right from the insurance company, right, Danny?
Insurance company, right?
Yeah.
Sometimes, there's not a clear cut how it works. One insurance company works like this, another works like this, another person they get reimbursed, whatever. Eventually, the insurance company pays for it, and we're collecting that rent, signed all in advance, not all the rent, but they signed a lease. And what I've seen happens many times is that even if if this is severe insurance incident like a fire, we just started with this lease for 11 months. My guess, they're not going to be done in 11 months. Those insurance companies, they are so inefficient. They will probably take 3 to 4 months just to get bids and evaluate and decide and make a decision and approval, right? And maybe this is 3 to 4 months for the insurance company to come up and say, okay, you can go and start renovation. That is a very efficient insurance company. So it may even take 6 months. And then it may even take another year to complete the renovation, not because for lack of efficiency, for lack of urgency, those type of tenants may end up staying more than 12 months, right, after the fact. Almost every time we had an insurance incident, even for a month or two, they extended, right? Another 2 weeks, another 3 weeks, another month, another two. I think that almost every time we had that they extended. So that shows you, even if someone comes for 2 months, there's a very good chance they will stay longer about it. So that's why those houses are in the suburbs. And then, what's always kind of a little bit surprising us, there is still demand for Airbnb short-term rentals in the suburbs, right? We had a guy he's moving from Nashville to Atlanta, and whatever family situation he's been, personally, he just shared with us. Such a nice guy. He just told us what's going on in his life. You could tell something is going in his life. Good guy, engineer, high earner, but he wanted a place. He actually took a very big place because he had need for room for the vehicles and the recreational vehicles, and our place was perfect for that, right? He said, I don't need such a big house, but I need something like this. And he had the money to pay. So we have all those kind of interesting stories of situations that are not just insurance. They're coming for a month or a month and a half or two, just because they need a temporary solution for whatever situation they're in. And they don't, those people do not necessarily want to live in the traditional vacational, short-term rental areas. They want to live in the suburbs. So we're in the suburbs and catering to the suburb, needs, so to speak. Yeah.
For the benefit of the listeners too, this is what's really interesting to me. And I'm going to break it down just a little bit for everybody, because this is important. When you're talking about the different levels, short-term, mid-term, and then a long-term, the cap rates, what you should expect in terms of a rate of return, are going to be different on all three of those things. I always call it the brain damage, right? The more brain damage I have, the more risk I have. I should get a higher return when I'm taking on more brain damage, when I'm taking on more risk. So when you get into that short term, like you said, it's like a business. It's very different than that long-term rental where you're putting a tenant in place. You're going to be constantly running a hospitality business. So what should you do? You should get a higher cap rate. You should get a higher rate of return for having that higher amount of brain damage and that risk. Where then if you get to kind of a midterm, you should have a little bit of a lower cap rate. Maybe, you've got less risk, less brain damage. Then you get to that long term. A lot of times people get cap rates that are sub 10 by quite a bit, thinking, well, I'm going to get some appreciation out of this. In 10 years, I'm going to look like this. So when I'm looking at these three different product levels, it's really important for everybody out there to know that these are all different types of risk, and your cap rate should reflect, your rate of return
Correct.
should reflect how much brain damage, how much risk
Absolutely.
you have. Yeah. So
For
I
sure.
know
That's
that,
exactly the way, yeah, we're looking at it.
yeah. Well, in
I said
breaking it
it's
down is
exactly
very
how we
important.
look at it. Yeah.
You were talking about analyzing your deals, right? Analyzing 150,000 deals. You didn't buy 150,000 deals. You analyzed 150,000 deals, right? So not every deal pencils out. The thing is you got to go through that process too. Because if you're not penciling it out, if you're not looking at it from an analytical side, you're going to lessen your chance. I mean, you can get lucky. There's so many people who've bought properties and got lucky and, have made a lot of money doing it, but try to take as much luck out of that equation too by doing what you do. Do the analytics, take the time to look at each property from an analytical standpoint to see exactly. See, I mean, it gives you a better idea of what you think you're going to make over the long term. And I can't believe how many people don't take the time to do that.
Yeah, yeah, unbelievable. I'm with you there. There's a twofold here. First of all, I think how many people do not really take the time to do that. For me, it's a second nature. I cannot not take the time. I can't help it, right? I've been doing it for such a long time. If I don't run even the property that I can in my mind do it, because I've seen it already so many times. I don't trust myself. 150,000 times later, I got to go to my Excel to verify, very well. And I've done, so we have an Excel, it's a fancy Excel, so to speak. We teach all our investors, all our agents to use it, but it's still an Excel. I mean, if one of my agents or one of the investors takes it and abuses it either way, um, it will show either very optimistic or very pessimistic, and we have to be careful. So I always tell them, listen, it really depends what the kind of a mindset you come into the analysis process and how you tackle this, right? And my approach has always been not best case scenario, not worst case scenario, but what I call realistic case scenario, and just a little bit, conservatism, right? I'm not even, trying to be a bit cautious, but not overly cautious. And that's how we approach the Excel, to not abuse it either way and try to be realistic and get true, good, realistic answers. And we analyze it over the long term, not over a year, not over a month. I don't look at anything, any analysis less than 5 years, usually even 10, but let's just 5 years. And then I want to see the performance of that property is over 5 years. And then what I've done several times, every once in a while, I pull a property, which I have those Excels going back as 10 years ago, more. I've probably lost folders over the years, at least 10 years, 12 years. So I pull them up. I have the analysis from 12 years ago, from 7 years ago, showing me 5, 10, 15, and 20 years analysis. That's what we did last time we opened the Excel. And I'm reviewing them and I'm doing, planned versus actual. Consistently, we get, I would say, we hit the 10-year projections in about 7 years, right? Just about 7 years. So almost every one of those properties, 7 years in, we are doing better than a little bit better than 10 years projections on rent, on value, on cash flow, just about everything. And that blows my mind. Every time I'm doing it, I'm like, wow, maybe. And then I'm like, am I too cautious? But I'm okay with it. Let's just keep it this way. But it's amazing to be able to have that all that data and to look back, pull that up and look back. And I'm so glad that I saved those, thousands of Excel files.
Danny, I'm called a conservative bastard all the time. I always underestimate my income, and then I always overestimate my expenses, and then I
Funny.
celebrate every win after that. I'll look optimistically at it too. But when I'm doing when I'm buying the property, I'm always going on the safe side of the equation to try, because you got to make money on the buy. I mean, if you're overpaying for a property, you're just going to lessen the probability that you're going to have a good return when you sell at the end of the hold.
Yeah, for sure. For sure. I agree with
Yeah.
that.
Danny, where can people go find more information about you and what you're doing?
Yeah. So first of all, I want to make sure everybody knows that if you look for more information coming from me, it will be mostly on long-term rentals and a little bit, that we put out there on mid-term rentals. Nothing on short-term rentals. I'm not your go-to whatsoever for short-term rentals. My web identity everywhere, every social media, website is my company's name, which is Simply Do It. Simply Do It. So if you write simplydoit.net, our website, if you just write Simply Do It Danny or Simply Do It Real Estate, you will hit my, either the Facebook or, we have probably close to more than 450 publicly open videos. We have way more that are not publicly open videos on YouTube. I've been putting stuff on YouTube for just about 15 years now, I think,
Oh,
something like
wow.
that. So there's a lot of content on YouTube. My style is always share, teach, share. I'm not very good at doing a sales pitches. So simply do it. Simplydoit.net, simply do it online. You will definitely find more content on long-term rentals, smart way to analyze. I really have a knack and liking to, let's just call it, kill some taboos like the 1% rule, or you always have to buy, 25 below market value kind of things. So I have, showing some example of some of our clients who end up buying in Austin versus or Oklahoma City versus Nashville at the same time for the same price, when I told them you shouldn't do that, and what happened. So I have a little bit of liking to be not just all sweet and cute and nice about this, but also show the reality. Really, really like to show the reality of things in a good
So
way,
if you want
not
to get a hold of
aggressive,
Danny, you
not
just got to simply do it. You just got to simply do it and get a
simply do
hold of
it.
Danny. One last question for you, though, Danny, before we end up here. If you could take one of your best pieces of advice for somebody who might be coming into the business, coming in as just an investor, it could be long-term, midterm, short-term. Just I'm an investor coming in. What would be the one piece of your best advice that you could give to a new person?
So yeah, so there's definitely something I mentioned early on about quality and long term. I think it's really valuable, but that's always already given. So I'll just say for those of you who are stuck or afraid, if you have fear or risk, or and you're not sure how to overcome that, my suggestion for you, regardless what kind of an investment you're going to make, just sit down with yourself or a good friend, that you can kind of brainstorm together and just itemize. At least don't call it risk or fear. That is a cloud. There's nothing you can do about it. Put it on a list and write, will it be red, will it rent, will it crash, will it who will manage, everything that you can think of that you identify. Break down the risk into components, and when you break down the components, you've done 50% of the work, identifying them. When you identify 50% when you identified all those risk or fear components, now you can divide and conquer. Say, okay, how do I know there's not going to be a crash? How do I know if I can get financing? How do I know if it will be vacant? Now you can tackle those one by one and then start getting answers. You're not going to get answers for all of them, but you will at least get answers for 80% of them, or satisfying answers for 70% of them. That's a lot already, and that will help you overcome the fear or the risk that a lot of people are just stuck at, like, I'm afraid, but afraid of what? You gotta specify, what are you afraid of, right? And then that will help you get unstuck with taking action. I hope that helps.
I'm afraid of one thing, Danny, and that's dying. So let's not be afraid of being investors for sure. Hey, Danny,
Yeah,
thank you
well,
so much for coming on the show today, my friend. I really appreciate you coming on.
thank you very much for having me. Thank you.
Thank you for tuning in to this episode of the Vacation Property Secrets Podcast. If you enjoyed the show, we'd really appreciate it if you could leave a rating and a review on Apple Podcasts or Spotify. By leaving a review, you not only support the show, but you also help others find and enjoy it just like you did. Also, please share this episode with somebody who could benefit from it. And if you're aiming to build a short-term vacation rental investment business that's based on strong investment fundamentals and not just emotion, I'd love to invite you to a free training that I'm hosting. It's my financial forecasting for maximum vacation home profitability training, an on-demand video course that's completely free. It walks you through the investment fundamentals to build and scale your short-term vacation rental business. You'll also learn how to estimate investment income and your operating expenses to build a projected pro forma operating statement and the potential NOI and return on investment for your property. Just go to vacationpropertyexpertnetwork.com to get access to your free training. We'll see you next week for another episode of the Vacation Property Secrets podcast.